This is Lori Charlton. It's June 20th, 2022. I want to welcome everyone to a special meeting of the Board of Finance. I'll call the meeting to order and ask that we all please rise while our colleague, Mr. Testani, leads us in the Pledge of Allegiance.
I pledge allegiance to the flag
of the United States of America, and to the republic for which it stands, one nation,
under God,
indivisible, with liberty and justice for all.
Well, can you guys hear me?
We can hear you, but can you hear us?
I don't think you can hear us.
Yeah.
I don't think, no.
Hang on.
Volume?
Okay, there we go. My volume's up.
Can you hear us now, Lori?
And now I can, yeah.
Okay,
Yeah.
perfect.
All right.
Better.
Okay, thank you. All right. Okay, so to the members of the public who have dialed in or joined us on the WebEx tonight, please know that you are muted and will not be heard by board members. There will be no live public comment during the meeting. Members of the public are always encouraged to send their comments and questions in writing to the board at the following email, bof@fairfieldct.org. If you do so, please remember to include your name and address as you would with live comment. This is a special meeting. It was not on our original calendar. The meeting was called to hear the two voting items on the agenda requested by the town administration. Also at our previous meeting, one of our colleagues had asked that we hear an update on the status of the WPCA digester issue when we gathered again. So that is also on tonight's agenda for a brief update. I want to thank my colleagues for making themselves available tonight on relatively short notice. Our summer break obviously didn't last very long. Moving to item 3, to hear, consider, and approve up to $300,000 from the Water Pollution Control Authority fund balance for the design of the Fairfield Beach Road pump station and force main. This item was heard by the Board of Selectmen earlier today, and I understand it was approved, and it will also require RTM approval if moved forward by this board. Information related to this item is included on pages 1 through 3 of the posted meeting backup and includes the 14-point summary as well as the draft minutes from the WPCA meeting where this appropriation was approved on June 15th. Can I have a motion to hear this item? Mr. Curley, seconded by Ms. LeClaire. Thank you. Okay, so this evening we have Water Pollution Control Facility Superintendent John Bodie and WPCA Vice Chair Joe Davanzo to take us through this item. Gentlemen, welcome. Thank you for being here, and I'll turn it to you.
Good evening. Thank you for having us. My apologies if I'm part of the reason you're all here and not on summer break. This is a real quick request. The $300,000 is to design the pump station. With the rising costs of raw materials, for unknowns as far as contamination in the ground and overall condition of the force main, we felt it prudent to get a design done, therefore to get a hard number to put on this project so we're not guesstimating, we're not undercutting, we're not overcutting, we're going to try and focus in, get a good solid price, then we can appropriate the funds out of the balance and move forward. So that is the whole reason for this. We'd also like to see if the pump station needs to be hardened in any way due to its proximity to Long Island Sound. And with all the weather that's been happening, the new normal, we thought it prudent to get the design done to get what we're after and a good price on it.
Okay, thank you for that. Comments or questions from board members? Mr. Curley?
Yes, thank you, Madam Chair. If I understand this correctly, the $300,000 is for the design only, not the project itself, right?
That is correct.
And I'm not sure if this is a question to Jared or to you, Mr. Brody, but where is this project on the overall capital spend plan? Is it on the waterfall?
This is on the waterfall for this upcoming year, fiscal year
Okay.
23.
Okay,
Yep.
perfect. And do you have a ballpark of what that placeholder value was in the waterfall?
I believe it was 2.1 was what the placeholder was, but I don't believe that's even close nowadays.
Yeah, things have gone up quite a bit, unfortunately. I hear
Yep.
you. And what's the basis for the 300,000?
We talked to an engineer and he thought that that would encompass everything we needed to get done, soil testing and just an overall look at everything that's there structure-wise, like I said, hardening, piping, pumping, you name it.
Okay, that's helpful. Thank you. No further questions.
Thank you, Mr. Curley. Other questions from board members? Mr. Testani.
Hi, hey, John, how are you? Thanks for coming tonight. Just curious, so would it be fair to say this was time sensitive? Was there a certain time, perhaps by the end of this fiscal year we're in, the end of June? I want to get an idea of both the financial piece as well as the engineering piece for the timing of this.
I guess the placeholder was kind of looking to have it done, start around July 1, but because we can't get a good price, the engineering will obviously be done after July 1. And then once we get the number, we'll get an RFP together and send that out and then move forward from there. I think we can get it done before July 1, 2023. That's my hope anyway.
Okay, thank you.
Thank you, Mr. Testani. Other questions? Ms. Leclerc? We can't hear you, Mary. There you go. No. Mary, we can't hear you. Mary, I'm not sure if you can hear me, but we're not able to hear you.
Can you hear me now?
Yes.
Okay, sorry about.
Is it me, folks?
I can't hear.
Okay. Yeah, Mary, we heard you for a moment, but then you cut out. Sorry. Mary, we heard you for a moment after you said, "Can you hear me?" But then you cut out, so we didn't get any of your question. All right, let's give Ms. Leclerc a minute. Does anyone else have any questions while she figures out the audio?
Okay, I think
There you go. Gotcha.
my phone got disconnected somehow, so I'm talking through my computer now.
Okay,
Hopefully that
good.
works.
Yes, that works. Thank you.
So did you hear any of my original question?
No, we did not.
Okay, sorry about that. What my question is when we go forward with the project, are there any grants available or funding available, or will this project be completely paid for by the WPCA, or is it a shared responsibility with the town? How will it work?
This will be funded by the WPCA 100% through the fund balance. So there won't be any cost share or anything like that.
Okay. And are you eligible for any grants or ARPA or any type
That we would have to look into. I'm not sure.
Okay, thank you.
Thank you. Ms. Leclerc, to clarify, were you asking about the cost of the $300,000 cost of the study or the ultimate cost of the project when you questioned how it would be funded?
Both.
Okay.
The main project mostly, but the design, usually both are included.
Both will be WPCA fund balance.
Okay.
Other questions from board members? Okay. I just have a quick one, Mr. Bodie. I saw in the draft minutes that were provided in the backup that you mentioned there was 2.1 million in the waterfall. I saw in the draft minutes that I believe the original proposal for this project was 3.5 million that was discussed, and then you guys scaled back and just decided to do the study to get a hard number. Is the 3.5 million the current thinking? Was there some basis for that, or was that just an estimate based on?
It was a wild guess. We conferred with an engineer, and he couldn't say that that was a solid number to go with. And we want to keep trying to do it and then coming back and flip-flopping and going before the board and say, well, we thought it was this, but it's going to be this. So we just wanted to do the design, get the number, and move forward.
Okay. And in terms of any environmental impact that it would have, any potential contamination, does that have a potential impact here?
With the way everything's going, contamination is a definite possibility. I can't say for sure, but we want to have soil samples taken to know that when they go to dig in the road near the station that there's nothing there. We'll have that information and we'll plan accordingly with the design, and then that'll transfer into the project cost if it needs be.
Okay, thank you. And that was my question, was would this study include soil testing?
Absolutely.
Whatever needs to be done so that we'll know
Right.
once this is completed, not just the theoretical design, but a better understanding of everything involved. Okay, thank you. Other questions from board members on this item? Okay. Well, seeing none, we can put this to a vote. All in favor of approving the transfer of up to $300,000 from the WPCA fund balance for the design of the Fairfield Beach Road Pump Station and Force Main, please raise your hand. Ms. Charlton, Ms. Leclerc, Mr. Testani, Mr. Curley, Mr. Walsh, Ms. Marmion. Opposed? Abstentions? Okay, it is unanimous. 6, let's see, I believe there's 6 of us here, right? Are we missing, am I missing someone? No. Okay, unanimous 6-0. Thank you, everyone. Okay, so we are going to move on to item 4 then, to hear an update on the Water Pollution Control Facility digester cover. This is a discussion item. There's no written backup for this in the meeting materials. Mr. Bodie, are you going to take us through this item as well?
Sure. What do you want me to start from the beginning? Do you want us to know where we are at the moment?
So this board heard a little bit about this issue sort of as a heads up from Mr. Schmidt, I believe, during our quarterly review. And then one of our colleagues here had asked for an update if we were to gather on this item. So we just wanted to understand basically where it stood. Do we have any further cost estimates, status of insurance, where we are in the process, et cetera?
We have no updated cost estimates. We have none, actually. The engineer that we hired is supposed to have some documents or RFP documents by the end of the month. And then hopefully that'll go out and we can get an idea. I talked to a few insurance people on the phone. An actual adjuster came out on June 1st. We walked the cover. He looked at the drawings. He was here probably about a half an hour, and then he left. He called me last Friday with a few more questions. He was still pondering the situation, and he said he'd get back to me in a week or two. So as of right now, I have no cost estimates. I have nothing from the insurance company, just waiting.
Okay, thank you, Mr. Bodie. Mr. Walsh? Mr. Walsh, did you have a question? You're on mute.
I'm sorry, my mouse fell and I couldn't turn off the mute button. So I apologize. I'm back together though, Mr. Bodie. So has the town retained a licensed public insurance adjuster?
That I can't answer. It's whoever the insurance company is for the town that covers the buildings here at the plant, they passed it off to their adjuster, which is through Hartford Steam Boiler.
Makes sense that we would, because they only take a percentage of generally like 10% of whatever they get. But the national average on insurance claims is that if you don't use a public adjuster, you get about 40% of what you're due. And if you hire a licensed professional adjuster, you get 120% of what you're due. So I'm not in your business, so I don't know. That's general terms for commercial insurance. But it would make sense, and I don't know if Jared's on.
I am on. Can you hear me?
Yes, Jared, do we use public adjusters for our insurance claims? And if not, why not?
We're using the same process that we've used in the past, which is to go through our insurance company, just like Mr. Bodie said, to go through the insurance company, and they have reached out to Hartford Steam Boiler to do the adjustment. So it's what we have normally done, from my understanding.
Okay. Is Attorney Baldwin involved? Is to read the insurance policies to determine what we are legally entitled to, because the insurance language in these commercial policies gets very complicated. And the great thing about the adjusters that I've used before is they know all the language. They know the language because they fight for their clients, because they're fighting for themselves as well to get a commission of 10% generally. So it'd be interesting to if you could talk to Attorney Baldwin and find out whether we use and well, we don't have do we have somebody in risk management now, or no one's still in risk management?
We don't have a the risk manager position is not filled right now. I know that Attorney Baldwin knows where we are in the process. There hasn't been a conversation about hiring a licensed adjuster, but we can certainly entertain that and see if that's an option for us, and how possible it is.
All right, maybe you could talk to our insurance broker. I mean, they should be working for us as well, right?
They are, yes, they are definitely
So
working for
can
us.
you run this idea by our broker and get his? I think it's a gentleman, right? Get his
Yes,
name.
it is.
He comes to our
Rob
budget.
O'Connor.
Yeah, that's it, Rob. If you could talk to Rob and get back to us about his thoughts on hiring an adjuster.
Sure. Yep.
Only because it's amazing the things that, you know, when you have an adjuster, the adjuster will deal with the adjuster on the other side to see. I mean, sometimes the claim is disclaimed for some provision in the thing. Now that becomes a legal matter for Attorney Baldwin or whoever he assigns as the attorney to see on an insurance coverage basis whether it should be covered or not been covered. But, you know, it would make sense, I think, with a claim this large to get, you know, a licensed public insurance adjuster on the matter. It's not going to cost us anything because they're only going to make money if they get us money.
Right.
So does that mean you'll get back to us about it? I guess.
Yeah, we'll look into it. Yes.
Okay. That sounds good.
Yep.
All right, thank you, Mr. Walsh. So just to clarify, Jared, who's running point on this for the town? Would that be you and Attorney Baldwin?
I think Mr. Bodie has had the most contact with the adjusters, and I've been involved to a certain extent as well.
Okay, and I really, what I meant is being responsive to Mr. Walsh's question.
Yeah, we'll take care of it.
Okay, maybe you could, since we're not going to be meeting again for theoretically for a couple months, maybe you could give us an email update.
Sure. We'll
All
do.
right, thank you for that.
Madam Chair, I just want to suggest that perhaps we have Jared, in addition to the email comment, at our September meeting.
Yes, absolutely, Mr. Testani. We'll get an update on this when we gather again. I just, until then, since that's a couple months away,
Right, yeah.
if there's any update that we can be informed of in the event that we don't have another special meeting. But yes, thank you. Any other questions on this item? Okay, thank you, everyone. Thank you, Mr. Walsh, for your input on this. Appreciate it. Okay, we're going to move on to item 5, to hear, consider, and adopt a bond resolution entitled "A Resolution Authorizing the Appropriation of $15 million to refund certain of the town's outstanding bonds and authorizing the issuance of refunding bonds to finance such appropriation." This item was also heard by the Board of Selectmen earlier today. I understand it was approved, and this item will also require RTM approval if moved forward by this board. The information related to this item begins on page 4 of the posted backup, and it includes both the bond resolution and an informational document addressing the proposed process around this refunding and some specifics around the numbers. Can I have a motion to put this item before us? Ms. Marmion, seconded by Mr. Walsh. Thank you. So to take us through this item, we have the town CFO, Mr. Jared Schmidt, with us. We also have Mr. Matt Spurndle from Phoenix Advisors, the town's financial advisor, and attorney Michael, I hope I'm pronouncing it right, Andriana from Pullman and Conley. Here, Jared, do you want to kick us off, or is someone else going to do that?
Sure. Yeah, sure. I'll kick it off and give an overview, and then I think a lot of the questions that might come up were in the Q&A document, but I'll start it off. As the chairwoman mentioned, the proposal is to refund approximately $15 million, and those issuances were from 2012 and 2014. We essentially follow the guidance and recommendations of GFOA in terms of, trying to determine what we need to achieve in order to make the refunding efficient and something that we want to pursue. And so the benchmark for this is that the net present value of the savings that would result equals approximately 3% of what we're looking to refund so if you break that down, $15 million, 3% of that is about $450,000. There may be, depending on the details, we may go as low as $350,000. And I'll let Matt talk more about this, but the situation has really been up and down since the beginning of the year, and most recently over the past week, rates have gone up a lot, which at this point in time would be difficult, if not impossible, to refund at this time, because it just wouldn't be worth it given where rates are at this point. However, it's a volatile market, and they could go down. And when we were first talking to Matt Spurndle about this, the rates were down and it was looking better. But as I mentioned recently, they've gone back up. So again, this is an authorization for us to move forward with this. It's not a mandate. And so if things change from where the market is now, and we find that rates are going lower and it looks like it would be worthwhile to pursue it, then we'd move forward with the refunding. So I don't know if there are any other questions about the details of the bonds to be refunded. But I'm open to those, and also we have our bond counsel and our financial advisor on with us. Thank you.
Thank you, Mr. Schmidt. Questions from board members? Mr. Walsh?
I guess this would be for Matt. Did these just become eligible for refunding because of a call date? These bonds that you want to refund?
Yes, Mr. Walsh, you're correct. We're approaching the call date. The call date's late July and early August for these two sets of bonds. So we really haven't had an opportunity to refinance these to this point on a tax exempt basis. You have to wait till your call date. So we're in that range now, and that's kind of partly what precipitated this whole endeavor.
Once you reach that call date, does that period remain open until the bond is paid off, or is there like, during the call date, is there a 30, 60, 6-month period of time that you can do a refunding?
Nope.
And then it closes down again?
No, it's open until the bonds get paid off. So, there's nothing that would preclude us from doing this at some point in the future if rates were to go down further. Typically, once you get to the call date, if you're in a good environment, a good market environment, that you can reach certain thresholds of savings based on, industry guidelines, best practices, those types of things, the refunding would be pursued. In this case, we're obviously in a very volatile rate environment, one that's kind of been nothing but up since the beginning of the year. So it's one of those things that, with the volatility, we could potentially have a scenario where, rates drop, tax exempt rates drop for 30, 40, 50 basis points in a pretty quick period of time, which we've seen already in the last couple of months. It's just good to have things lined up to where we can act quickly if the market is favorable. And on top of that, with the new money issue that we're selling on Wednesday, we have ratings and bond sale documents and things that provide some economies of scale and reduce the amount of time it takes to react to a favorable market scenario to take advantage of said refunding. So it's just kind of a situation where it kind of makes sense to do this now. I wish I could say that the numbers were looking great, but we had a bad, week in the municipal market about, last week. So we're kind of at that point where we try to get the ducks in a row and be ready to act in the event that the thresholds are met and the objectives are met.
And that seems to make a lot of sense, especially with the savings of not having to go to the rating agencies again and pay for that, right? How long a period of time can you use the two rating agencies' reports? How long do they
rating agencies usually give you about 90 days.
Okay. So after 90 days, it becomes a little less desirable because we're going to have additional expenses.
Well, there'll be more work involved, which will take more time. The rating agencies now would have to be re-engaged, so it would prevent us from acting as quickly as we'd like, and there would be some incremental costs on top of that. So we would need, obviously the ideal scenario is rates drop in the next, month, and we can jump in there and get it done. Otherwise, it's going to be a little bit trickier, but we've seen pretty large market swings before and right when you least expect it. So we just keep our eyes on things and see how they progress.
Is the bond market tied to what the Fed does with rates? Is there an indice that the bonds are tied to, or is it just not tied to anything? Like residential rates are kind of tied to an indice, the 10-year bond or whatever. So
residential rates are loosely tied to the 10-year Treasury.
Yeah.
And your credit card's tied to the prime rate, which is tied to the Fed funds rate directly. In this case, it's really tied more to what the bond market is willing to give in terms of pricing and yields and things of that nature, which is a direct result of what their expectations are for the Fed funds rate moving forward and inflation moving forward and all those kinds of things. There's nothing that directly link it, though. It sort of prices off the Treasury curve. We're talking about potentially, well, in this case, the refunding, it's a shorter term, but typically you have a 20-year bond issue. There's 20 maturities along the curve. And depending on how Treasuries move, municipals tend to follow or react to those movements. In this case, we've had a bond market where rates have gone up quite a bit, doubled plus since January 1st. In the meantime, municipal rates, tax exempt rates, have actually, the relationship is somewhat deteriorated because they were trading strong relative to treasuries. Then they started trading weak over the last few months. But then all of a sudden in the middle of May, the funds sort of started buying treasuries, municipals again. And even though treasuries didn't move much over that course of time, we saw a 50 basis point improvement in municipals. So it's like stuff like that that could happen that you as a, sort of typical financial person, investor, might not see because you're not looking at, the tax exempt market with that type of a microscope. And it was surprising to me because that's not a normal market movement, but that did provide the opportunity at least to say, okay, if this stays stable and we can apply these numbers to the town, we might have this refunding, we would have this potential refunding. And then of course, 2 bad days pretty much wiped all that out, but 7 good days could bring it back. So sad to say.
Okay, so this would simply be to give you guys the ability of the town, the ability to take advantage. How long does it take you to, if the rates get better, more favorable for us, how long will it take you to turn that into, what is it, an auction you put this at like you normally do on bonds, the refunding?
Well, potentially. It depends. You didn't catch everything. You got really quiet there, but then you came back. Was that the same with everybody?
Yep.
Or was
It's
he,
probably
okay.
too far away from the microphone. Can everyone hear me now?
Yes. Yeah, I
Okay.
think,
Yeah,
I think you
better
got
now.
I think the gist of the question came through though.
Yeah, I think I got the gist. And the bottom line is this: if rate, again, we have the new money sale this Wednesday, then we'll obviously have some work to do with that. But in the meantime, if rates continue to improve, which obviously we all want, we can, with authorization in place and with the ratings in place, and we could move, very quickly within a couple, week, 2 weeks, 3 weeks, depending on whether we decide to put it out as an auction type format, like we do with the new money, or we engage an underwriter ahead of time, like at that moment, to find a good fit. That's to be seen, and that depends on the market. If it's extremely volatile or if it seems more stable, those things will come into play. But potentially, it could be sold similar to the new money, but in an environment where we have a little bit more volatility and a refunding that is a little bit leaner as refundings go. That we want to make sure we hit certain savings thresholds. We might want that underwriter on board ahead of time. So that's something that I'll have to give some extra thought and see kind of where things are when the rates hopefully kind of put us back in a favorable position.
Do we have to go forward with, if we set an auction date, let's just say on that situation, we set an auction date, the day before the markets deteriorate greatly, can we pull that and not do the auction?
We can pull it regardless of how we do this, how we would do this. We could pull it up until the thing's selling at that moment in time.
Okay.
If the bids come in and something happened that morning, and now all of a sudden, instead of the savings meeting our threshold, it's a fraction of what we were looking at, we can reject all bids. So we have that ability, we have that right, and it doesn't typically get to that point because we know where the market is, and we wouldn't necessarily force it into the market if it didn't look like it was going to work. But that's why potentially if we did have an underwriter on board ahead of time, we could at least have that feedback ongoing with the underwriter to as far as timing and tweaking numbers and things like that. So again, that's all to be determined.
Yeah.
But you approve this tonight, it doesn't lock you into anything except for the ability to proceed if the numbers work.
Okay.
So
I was just asking the question because you said that over a 2-day period, there was a great deterioration. So it just seems like the market's a little bit volatile in the last week or so. So that's the reason I was
Exactly.
asking those questions. So thank you for explaining that.
Oh, absolutely. Anytime.
Thank you, Mr. Walsh. Other questions from board members? Mr. Curley?
Yeah, thank you, Madam Chair. Yeah, just a couple of quick ones. I appreciate all the detail that was helpful understanding the process. I guess my question, two questions. I'm looking at page 7 of the backup, and it shows a series of the different par values and interest rates that vary. Will you be able to cherry pick this a little bit? You talked about having to have an appropriate savings on the rate to make it worthwhile. It may be that perhaps you'll have that sufficient gap or savings on some of this, but perhaps not all of this.
That's a good question. I mean, we could potentially pick a handful of maturities and leave the rest out there. In this particular case, if I'm looking at these rates and the timing and the term of these bonds that are left over, my guess is it's going to probably be all or none. We would have that ability to do so. But I mean, the bond that goes out to 34, you know, they're all at 3s. You know, maybe a little bit higher than that. And as we start to pull bonds out, we're going to lose some savings. We're going to lose some efficiencies. You know, unfortunately, the bonds that make up half of the deal only go out to 25. So no matter what, we really can't generate a ton of savings on those to begin with. Even though they have the 4 and the 5, you're only paying it for another 2 years. So right. Yeah, we do have that ability to do so. My guess is it'd probably be all or none at this point.
Okay, that's helpful. I'm all set. Thank you.
Okay. Yep.
Thank you, Mr. Curley. Other questions? Okay, just a quick one, Mr. Spurndle. Can you help us understand a little bit more about the GFOA benchmark of 3% of the total bond issuance, how that's derived, and in this case, with the $15 million of bonds, what would that produce? And I know obviously it depends on what the market is and what we go out for, but if we had done this at the optimal, you know, if we had captured this moment a couple of weeks ago, whenever it was, what would we have been talking about in terms of annual savings and interest expense?
If we had captured this exactly at the moment it dropped, we would probably be around 500,000 of savings would be my estimation. And that, under the scenario that we sort of start with, it's, you know, more of a savings spread in the first few years. So maybe you get 100,000 for a few years, then it sort of drops out. You could tweak that as you like, but let's just call it 500,000. Now that's a gross savings number. The GFOA number is relative to a present value savings number. So when we look at it and we talk about thresholds and percentages and things like that, we look at it as a present value number of those savings going forward, discounted back at the cost of borrowing, and you take that number, which in the case of a 500,000 is somewhere in that 450,000 net present value ballpark. Obviously, a dollar today is not worth the same as a dollar 15 years from now. So that's what that's all about. So if we were to take 450,000, and the way the GFOA puts out their ratios, they basically say present value divided by the bonds you're refunding. So basically, the present value savings divided by the old bonds. Now we're rounding to 15 million. It's actually less than that. But if it were 15 million just for round numbers, and we had 450 of present value savings, we're exactly at 3%. Now that's just a kind of a guideline. It's just a way for the GFOA to say, you know, if it's at this level or higher, it probably makes sense. If it's, you know, much below, then maybe you should wait. But there is some language in there, you know, because again, this isn't a rule, this isn't a statute that you have to meet these savings thresholds. It's just sort of a guideline. And in the GFOA language, they do reference the fact that if you're in a particularly low interest rate environment and you don't think rates are going to come back down in the very near term, or the bond, you know, or you've reached the call date and right now you're kind of missing the opportunity to refund as each day goes by, then you can justify something under 3%. I mean, you know, I could be having the same conversation in another town, and they'll say, well, we don't care about what the GFOA has to say. If we could save the taxpayers $300,000, we should do it. And there's nothing wrong with that either. And, you know, the rating agencies aren't gonna, you know, come after you or anything like that. It's just something that's used sort of as a guide to help model the decision-making process. And it was really more useful, I think, pre-tax reform 2017, where there would be issuers that would refund like as many bonds as they could that were well, you know, far away from their call date, because you were allowed back before that time to advance refunds. Now we're getting a little bit more technical, but to advance refund bonds. And we did that in numerous towns. And what that means is you could do an advance refunding, so you could be more than 90 days away from your call date, do it on a tax-exempt basis, and, you know, same kind of thing, savings and the ratios and all those things would still apply. In that case, though, because you're so far away from your call, there was some negative, you know, there were some inefficiencies with arbitrage and a lot of other things that I think the GFOA was sort of more concerned about, you know, giving up the opportunity to refinance them when you got to your call date because you were going to do so far in advance. So that's just a quick little background of the GFOA and how they came up with that number. And maybe I got too, you know, into the weeds, but that kind of explains that a little bit.
No, that's helpful. And I guess that was my question. If we were, you know, if the town concluded that, you know, we didn't anticipate that rates would, you know, go lower in the foreseeable future, or substantially lower, could we, you know, could there be a decision made to move forward with this, even if the savings were under that 3% threshold? That was really my question.
Right.
You answered it, and the answer is yes, if that's a judgment. And I guess my other question I just want to understand, but back to the interest savings. So does this work? So the savings that are produced, how does that get accounted for in terms of flowing through our budget? So for example, when we have bond premiums, they all have to kind of flow through our budget process and be captured in the first 3 years or whatever. How, to the extent that there's interest savings on these bonds, would they be realized from a budget perspective over the remaining life of the issue, or would they be captured over some period of time from a budget perspective?
No, that's a great question. I think it depends. I'll just tell you, in the flexibility you have is pretty much endless. The one, and I think Mike will nod his head when I say this, is when we have savings in any given year, let's say you want most of the savings in the first 2 or 3 years, let's just say, which we can do. We don't want to have negative savings or dis savings in any of the years out, you know, beyond. You don't want any negative savings or dis savings years, because then it sort of touches on a different type of a deal, which is more of like a restructuring, where you might just basically be kicking the can down the road. And I can give you some examples: Hartford, New Britain, blah, 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 the list goes on, where they take savings in the first year and then they pay more for the next 10 years after that. So outside of that one little rule, we have maximum flexibility. Some towns like to take it in the first year or two. Some will just spread it evenly throughout the course. I mean, these go to 2035. If you spread them out evenly, you don't really feel it as much. And if you have a need and, you know, new debt coming on, and you want to try to offset some of that, or at least a little bit, it might be more helpful. So we do have a lot of flexibility with that, and that's not something that needs to be decided today or any, you know, not up until really a few days before the pricing. And the way that you account for that is basically what happens is, you know, you have a certain debt service schedule associated with these bonds moving forward. But if you did nothing, you would have that schedule for the next 13 years on these bonds. If we refinance them, we're just going to basically remove that debt service schedule and replace it with this new schedule. So, you know, just moving forward, you would pay somewhat less in debt service than you otherwise would have going forward. So that's kind of how, it's not like you get, you know, a cash inflow or influx, you know, this particular year or that, or you receive it like premium. That's not how it works. It's just a debt service schedule with lower amounts to account for the savings from the interest.
Okay, so it sounds like there's flexibility, and that's a decision that's made by management at the time of the
Yeah, yep,
issuance?
exactly. Sometimes it's the finance director with the, you know, with the mayor or the first selectwoman, you know, or man, it's kind of one of those things that gets decided sort of as we get closer. There are sometimes some restrictions as far as, well, if we're funding bonds in these particular years, we can't maybe get as much savings as we want, but we have a lot of flexibility with this one. So, yeah, that would be something that would come from the finance department, which may, you know, have interaction with your board, of course. So
Okay, and
that's
what
what I
do
would
you,
say there.
yeah, can you, what has the town done in the past? Do we have a practice of how we've handled this in terms of, you know, taking savings over a couple of years, over the life of the bond? What have we done? I think the last refunding, which was maybe 2 years ago, which was the, you know, first, I think, and only one since I've served on this board. Yeah, I don't remember the discussion coming up, but does the town have a practice that it's followed in terms of how we account for this stuff?
I wouldn't say a practice because again, it's really been one time in the last 6 years. Really, we did a handful before then in the 12, 15, 16. But I mean, that's a pretty big gap between then and 2020. And in the 2020 issue, we had a lot of savings. It was like $1.7 million, and I believe it was spread evenly throughout the issue, which I'm just looking up right now as we speak. It'll take me another not even 10 seconds, but you know, it's one of the, yeah. So that one was pretty much spread for the most part, even maybe a little bit more, maybe 200,000 the first few years, and then 100,000 for the remainder. So I wouldn't say you have a practice or even a procedure in place to do it. You have the flexibility, and a lot of it comes down to what you have coming up. What are the constraints you're dealing with now? How much savings are there? You know, you take 500,000 and spread it over 12, 13 years. It's almost like you don't feel it. But if you know you have, you know, a big bond issue coming up, and you can at least put 300,000 or 400,000 into that year or the next, it might actually be more meaningful. So those are some of the things that come up into the conversation when we talk about this with towns.
Okay, thank you. Other, Ms. LeClaire, question?
Yeah, I just have a question in that I thought we did sort of have a policy in place that it would never increase the payments in any given year. And I guess Mr. Spindell referenced that like there's some towns that did have that history, but I thought it was our history that we would never increase it in any given year. But I do think we did, if we knew we had a few bad years ahead that there was a big payments due, sometimes they did allocate a little more to particular years to try to smooth out our payments.
I could just jump in for a second. One thing I will say is not paying any more in debt service on any given year going forward as a result of their funding is kind of more of a standard for any town, because there's other rules and statutory things that come into play if you're going to take negative savings. In other words, pay more in the future than you're saving, and you're getting savings today. So I would say that's sort of like the baseline. Like we would never propose that you pay more in outer years and pay, you know, and get the savings earlier. It's just a matter of whether you want to, you know, allocate it smoothly or more in the front or back. You know, that's kind of the overall gist, which was to your point. You know, if you wanted to take it over the first few years for smoothing, you could absolutely do that.
Thank you.
Thank you, Ms. LeClaire. Other questions? Okay. No other questions from board members. All right. Any questions on the resolution itself? Language of the resolution? Okay, I see none. All right then, so we will move this item to a vote. All in favor of adopting the resolution as set forth in item 5 of the agenda, please raise your hand. Ms. Charlton, Ms. Leclerc, Mr. Curley, Mr. Walsh, Mr. Testani, Mr. Stark, Ms. Marmion. Opposed, abstentions? Okay, thank you, everyone. The item carries 7-0. All right, well, we appreciate you being here, Mr. Spurndle, and Mr., oh gosh,
Andriana.
Andriana. Did I have it right the first time?
You were perfect.
Well, welcome.
I tell you, between
Thank
both
you.
of the last names, you nailed both of the last names perfectly. That is like almost impossible. So,
Well,
thank you for
and
that.
thank you for being here and standing in for
Sure.
Mr. Staffstrom. So we appreciate it. Okay, that is it. So we are going to then move to item 6. I'll take a motion to adjourn. Mr. Curley, seconded by Mr. Testani. All in favor? Okay, it is unanimous 7-0. Thank you very much, everyone. See you soon.
Take care.
Thanks all.